audits and administrative monetary penalties are increasing in almost every jurisdiction, especially when it comes to crypto payments, fintech, and cross border, because all of these governments are under pressure to not only finally apply legacy regulation to these modern businesses, but also to try to keep some money in the country. Why are we still talking about how to bank proof your compliance program in the year 2026? I mean, we're looking at historic executive orders and laws being passed. We're looking at Trump passing the Fair Access to Banking Act or whatever it was called that says, you can't politically de-risk, you can't politically close accounts, you can't apply something like unacceptable risk, one of these amorphous, diaphanous terms that banks use to get rid of you that just says basically, we don't like you, we don't want you, we don't want to quantify it or tell you why, but there's the door. You got 30 days. Hope you're not overexposed on credit because we're going to call any and all loans on day 29. And, we wish you the best in your future endeavors. Good luck trying to run a business without the ability to intake and send out government money. So, I mean, why are we still talking about it? Why is it still relevant? The question gives you the answer. It's more relevant than ever in 2026 because even with all these favorable tailwinds, all this noise in the news, all this stuff saying, okay, like it's easier to get a bank account. Big deal. Even if it is easier, it doesn't mean that it's easier to keep it. And if you look at the companies that are benefiting from this fair access to banking, governing thing, it's like, okay, firearms dealers can get bank accounts easier. Big deal. That doesn't have any impact on crypto. Porn sites can get banking easier. Big deal. That doesn't have any impact on banking as a service, modern fintech, cross border remittance, and it doesn't actually give any true guidance to any of these businesses that are historically, losing these accounts, being hamstrung, and then pushing into worse solutions, offshore solutions, longer settlement times, and so on. The reason I think that we're still talking about it is because even with a bunch of fanfare, a bunch of legislation, anything that tends to decrease the bad aspects of this, it's had zero net effect, right? So you're not having any of these larger banks that have good tech, that have assets under management, that have fast settlement time. They're not like, yeah, I'd love to try it out with a fintech startup. Yeah, I'd love to, welcome some nested flows into my correspondent banking relationships. I'd love to put you in the driver's seat. I've spent centuries building this bank. Here's the keys. Why don't you drive for a while? Why don't you be in charge of underwriting and approval? Why don't you be in charge of settlement? I don't mind. This is your bank. You go ahead and take it. I think I'm pressing down on the point, but the point is, even if you have fair access to banking, that doesn't mean that fintechs, banking as a service, cross-border remittance, and modern payments have access to good banks. They have access to the same tier two, often distressed, no tech stack, no solution whatsoever, no good correspondent account, lengthened settlement times, held funds because the compliance is either old or non-existent, and burden is pushed on the founder, pushing up costs. This stuff is all still the same. This is the landscape that we're dealing with, and this is what founders have to look at. And you're never going to catch up to Coinbase. You're never going to catch up to Kraken. You're never getting like the global, tier one banks that these guys have. You don't even have the opportunity to enter that arena. So you have to do more with less, and you have to help your bank manage you. There's global financial uncertainty. There's war. There's, domestic treasury is getting tightened. Inflation is making governments have less money. People are paying more tax for less services. There's, the equivalent of breadlines in every country. And why does all this matter? Why does this relate to fintechs? Not only is it harder to succeed, but also your bank is feeling these global pressures, and your bank doesn't necessarily want to jeopardize their core business to give you a chance. They don't necessarily want to disrupt lending people money to buy homes, lending people money to buy cars, lending people money to go traveling on 20% interest on their credit card. All of these things are how banks make money, right? And if you're reading any of the clickbait, rage bait news cycles that say people are buying less homes, people are buying less expensive jewelry, people are buying fewer cars, banks are, facing a diminishing revenue base there, and they don't necessarily want to shore it up with your high risk stuff. So why will even good actors, why will even good businesses be losing their banking in the next few months, the next year? The answer is simple. I mean, audits and administrative monetary penalties are increasing in almost every jurisdiction, especially when it comes to crypto payments, fintech, and cross border, because all of these governments are under pressure to not only, finally apply legacy regulation to these modern businesses, but also to try to keep some money in the country. And by nature, these banks are also like, we'd like to try to keep some money in these banks, so that we can lend against it, so that we can have stronger balance sheets, so that we can finance and fund local businesses that contribute to GDP and tend to make the country stronger. And I think often, like fintech founders, startup guys, whatever, they might have a really good understanding of crypto. They might have a really good understanding of cross border remittance. They might have a really good understanding of, diaspora based finance. You get to a new country, you need financial products. The local banks won't help you. You can't get money home or get money from home over here to start your new life. People understand that stuff really well, but they don't necessarily understand that banks make money based on other things: assets under management, wealth management, lending against those funds. And countries don't make money off fintech either. So if you're not leaving money in the country and you're not leaving money in the bank, you're not truly supporting that bank's regime, and you're not truly supporting that country's tax regime and ability to make money either. So even good actors, even folks with good performance, when we're in a news cycle that has pig butchering and romance scams and retail fraud and senior citizens and vulnerable cohorts losing money, losing funds, losing their lives, even with good performance, you might still get squeezed because the compliance regime changes. You might still get squeezed because the bank decides, listen, we're concerned about global trends in finance. We're concerned about assets under management. We don't really need the profit that our fintech sector or our banking as a service or our sponsor bank thing generates, because we have to carry these many employees. We're under exams from our correspondent banks all the time, and we need those correspondent banking relationships to help our high net worths and the large businesses that hold large balances with us do global business. We can't afford to lose a correspondent relationship. We can't afford this. We can't afford that in a world where it's like the bank has these pressures, the country has these pressures, and you're, just a little guy doing 100 million a month or less. The bank doesn't want you. It's not interesting to them. It's not profitable. And they're under pressure from the government to say, okay, like every time you get audited, we're looking at that little guy and is it worth it? That's 1% of your business. And unless it's a compelling amount of your business, and unless you're contributing more, you're going to get gone, because the risk management strategy is either mitigate, transfer, or avoid. So if you're mitigating, it's going to cost you money. If you're transferring, it's going to cost you money. If you're avoiding, zero. A question that we always get from clients, and we're a risk management firm, so people ask us how we're going to manage risk, and frequently that risk is, how do I manage or future proof the critical banking relationship or relationships that enable me to do business? And in a lot of these, in the world at large, I wanted to say in a lot of these countries, but it's in almost every country in which our clients do business. There's a very short list of banks that have risk appetite and resources and pricing that make them attractive to fintechs. It's a very short list, often less than 5 banks. So how do I obtain accounts at all of these banks, and then how do I maintain them? So how do I bank proof my compliance program? And it's like, I've mentioned in other content, often founders don't understand how banks make money and so on, but you don't require a Rosetta Stone. You don't need a Duolingo to learn how to speak bank. You actually just need a consistent, measured, and informed by experience approach to your compliance, right? So, how do I control cost events and how do I maximize profitability for my bank? So when a sponsor bank is looking at onboarding you, when a sponsor bank is looking at giving you the keys to the kingdom and letting you manage the two key elements, which are underwriting, you get to identify your customers and decide when they get accounts and when they lose accounts, and settlement, you are in charge of receiving funds and sending them out to sub clients and so on. And I'm speaking almost specifically about clients that have sub clients now, right? Like if you're just an OTC desk or you just deal first party to first party, you have no nested flows, it's a little different. It's a little easier for you. But the answers to the questions are the same. Ensure you're aware of the legal requirements for identifying clients. Make sure you meet them. Rarely, if ever, waive them, and only waive them or do flexible and simplified due diligence in the case of a publicly traded body where you can't identify the owners because there's thousands of them that own stock. You have to be progressive. You can't do checklist compliance in this case, but you can be measured. You can apply the law and you can ensure that you document and communicate. And beyond KYC, beyond everything, ensure that if you're taking on risky activity, i.e., retail interaction. Okay, so retail interaction, and when I say retail, I mean you're taking small amounts of money from individuals that are, dipping a toe in investment. They're getting crypto exposure by buying a Bitcoin. They're learning about meme coins because there was an executive order or because they saw the Hawk Tuah podcast one time or whatever it is, right? If you're dealing with that riskiest, most vulnerable client base, you can't have that create cost events for your bank. So you need to make sure that if you're accepting wires from these people, you're taking fraud prevention steps. You're not waiving liveness. You're doing confirmation calls at usage thresholds. So if the unthinkable, and the unthinkable is incredibly common, happens and a fraud victim lies to you and is getting scammed or whatever, and they charge back everything, the wire chargeback process is your bank being like, hey, we got a wire charge back. We're concerned. And you're like, oh, bro, I did all this stuff. We made sure the person lied to us. We cannot control people falling for crime, but we can control taking a proactive approach, advising them of the risks, making sure that they actively tell us they're not the victim of a crime. In some cases, things I've done is, make them walk through where they live with the camera turned on to prove to me they're not under duress, to prove to me that there isn't a person with a gun in the other room. And some people out there are going to scoff, and some people out there have managed thousands of retail fraud cases like me and are like, yeah, it's not bad. I've done that too. So, I mean, what are you going to do to make your thing bank proof, to make your compliance program unkillable beyond controlling these high risk events and being aware of how they impact your bank's profitability? You have to be aware of the other side, which is your bank wants to make money, your bank wants to reduce operational drag, and your bank doesn't want it to cost them money, cost them reputation, and cost, their stock price or whatever it might be to bank you. So are they willing to stand next to you in a room? Do they benefit from it? Is your compliance team good? Do they tend to respond to RFIs in under 24 hours with good information that shows they identified the nested client, they're aware of the source of funds, and they can help that bank protect their correspondent banking relationship without a ton of overhead? This is incredibly simple. Ensure you don't cost your bank money. Ensure you make your bank money. Founders and startup people and clients ask us all the time, what's the bank looking for? How can we be more palatable? And I've mentioned this a couple times, many times over the years. You need to ensure that you are not costing the bank money to support you and that you're actually tending to increase the amount of money that they make. So if they have a bad tech stack, you're not sitting there saying, hey, listen, I want you to enhance your tech stack to get my business. It's like, why would anyone do that? You have to be realistic about it. You have to ensure that you know how transaction processing works, and ensure that you maybe have the money. If it's an asynchronous notification process, if you're not getting real-time notification of deposits from your bank, you have to ensure that you're crediting your client based on someone sitting there and looking at the statement, looking line for line in the GUI, or you're writing a scraper that can generate these notifications yourself. You can't go to your bank and say, hey, listen, it's already high risk to bank me. I would also like you to take on some tech spend and divert from, roadmaps that are usually done years in advance. I want you to make a plan just for me. And also, I'm not going to carry a minimum balance because I either don't have money or I have a treasury strategy that prioritizes other jurisdictions because, for whatever reason, I'm leveraging regulatory arbitrage or whatever. So you won't make money off me. You'll need to hire people to manage my account. I'm going to endanger critical things for you, like your correspondent banking relationships that allow you to do cross border payments, and you won't make any money doing it. Please open my account. I can remember a lot of crypto winters, and I can remember a lot of conservative banking cycles. And I actually have to be incredibly frank, like despite the news cycle, despite the fanfare, despite the new legislation and the examination, of the financial ombudsmans of this problem, we're not seeing a change. I don't think we've exited a conservative banking cycle for fintech, crypto, and payments in over 10 years. So we get the same questions for appliance forever, which is how do I prepare my documentation to defend myself? How do I ensure that if I'm in a scenario where I've been placed on a warning, or if I've had a transaction RFI triggered on a super high value transaction for a high net worth client or a really important corporate client, what can I do? And it's like, well, it's the same thing we recommend that you do literally all the time. Understand your own corporate structure and have it mapped out in a clear way that somebody can look at. Have your policies and procedures mapped to current changes in legislation. Do horizon scanning and update things to encompass, it's a very dynamic world right now. There's a lot of war, there's countries being invaded, there's shifting sanctions regimes, there's money leaving countries that are under sanctions to service, the rich landed populace of that. And it's like, are you aware of this? Is your program responding, or are your policies and procedures on an annual update cycle, with, somebody that's asleep at the wheel doing them? And in terms of the defensive data room, is it easily understandable? So I can remember years ago, we were dealing with a very, let's say, conservative processing bank that is actually, very, very up there in the industry. A lot of people use them, and they must have been under some scrutiny by one of their banks. It's a fintech, it's a banking as a service provider, multi-currency, has crypto enabled, has instant settlement between people on the network. It's what you want in modern finance, but they were triggering RFIs like crazy. And it was like, okay, like, how can we be more proactive? How can we help you manage us? So one of the things we did, which we find people don't really do, they want to scurry around, they want to hide, they don't want the light shine on their operation. We were like, hey, we just want to talk to the compliance team at the bank. Could we please just talk to you guys so that we can calibrate our process to what you want, so that we can understand what you're going to ask for and make sure that we have it? How can we understand what your average processing time is, what your volume of RFIs is, and how we can exit the RFI process quickly? And, they were willing to work with us. And the answer was not surprising. It was, please make it visual so that we can process it quickly. Please ensure that we have access to everything if we want it, but we don't necessarily have to get all of it because we trust you. We spot check you often, and we know you have this stuff, and we know the accredited third-party vendors that you use. So we know it's incredibly unlikely that you have fraudulent documents, sanctioned individuals, and we can rely on you not knowingly accept them and still say that we do not knowingly accept fraudulent IDs, sanctioned individuals, listed parties, whatever it might be. And then how quickly can you provide it? So we just shifted from, I hope we don't get an RFI, I hope that our wire doesn't get held, to, we'll get an RFI on every transaction. Our wire will be held on every transaction. We need to be ready to defend it. We need to be ready to exit the RFI cycle in under 5 hours. And it's like, if you aren't operating in the reality that, like, your bank has other clients like you, your bank and your bank analyst is going to have hundreds, if not thousands, of these alerts, and they don't want to take on managing you. They don't want to take on overhead to manage you because as we've said time and time again, and many times throughout this cycle, if you're not profitable, right, if you're not generating a lot, they're not hiring people to help keep your account. They're just overworking a middle level or junior analyst. And that guy is looking at a big stack of paper every day and being like, I need to clear these alerts. It's either demarket this person because their files are trash or prioritize reviewing them because they make it easy for me to do my job. Throughout this series, we've done a lot of stuff around like, how do you be profitable for your bank? How do you help your bank make money while making money yourself? And one of the questions that we get, and I guess one of the overarching trends, is how do you lower your risk? Because if you're cross border, if you're payments, if you're crypto, you're already in the elevated risk category. It doesn't even matter if you're the best operator that's been at it for over a decade, that has, thousands of staff and is the Silicon Valley success story. That doesn't matter. You're still high risk because of your industry, because of nested flows, because of the immediate fulfillment nature of these transactions. There's always going to be fraud risk. There's always going to be money laundering risk. There's always going to be risk to your correspondent banking relationships and so on. So how do you reduce that and still grow your business? I mean, you can easily review every other video that we've done in this content series, or you can look at your profile and say, okay, how does finance work? How does older analogs, high risk products like credit card acquiring match to current transaction processing and current payments? And it does match in that you have essentially a revolving credit agreement with your bank, because especially if your funds and your deposits are vulnerable to return, they're either pull payments from your clients or your clients are a vulnerable cohort or both. You have elevated fraud risk, elevated return risk, elevated account closure and freeze risk for your bank. So you're already in their high risk 20%. So if your portfolio looks like all high risk clients, you're either taking up your bank's entire high risk appetite, which maybe you're doing that because you are so wildly profitable and innovative that they're willing to do it, or you actually need to balance your own portfolio with low risk activity that either still makes you money or is a loss leader against your high risk activity and allows you to load balance and allows you to pull your fraud to sales ratios down and allows you to pull down those overhead events that risk your bank account, that risk your merchant account. And in credit card acquiring, we had this all the time because Visa, MasterCard are really good at this. They track returns, chargebacks, refunds, requests, complaints, and arbitration with reason codes. And if you spike in a certain reason code, you have to address it, identify what happened, give them a concrete plan with dates to reduce that activity, and then return to the review process and say, I succeeded or I failed. And if you failed, you have to recalibrate or lose your account. And what we find is there's a lack of experience with this kind of account management. There's a lack of awareness of this kind of ratio and load balancing in a lot of startups and a lot of founders, and even in a lot of medium-sized established businesses, that they don't understand the playing field and they don't understand how they fit into the portfolio. So if you want to reduce the risk of your business, you're going to have to identify activity that balances out your highest risk. You're going to have to reduce that risk, and you're going to have to take on overheads. Gone are the days where you can have one compliance analyst with 20,000 alerts on backlog making a couple of verification calls a day. That isn't going to work. That isn't going to cut it, and that isn't going to preserve you through any regulatory audit, through any second line of regulation, which is banks audit. And frankly, you're just going to lose all your money and either close shop or you're a criminal in the first place. So what metrics actually prevent account termination? Like, what does your bank look at when they're deciding to get rid of you or keep you? They're looking at things like fraud events, chargebacks, RFIs, transactions to sanction adjacent jurisdictions. So like, obviously nobody's sending wires to Iran, but if you're doing a lot of wire activity in the Middle East, or you're doing a lot of wire activity in Eastern Europe or sub-Saharan Africa, your bank is like, hey, I have very little appetite. I have very little appetite to have wires that touch either war-torn jurisdictions, sanctions-adjacent jurisdictions, or tax havens. I can't push up my risk profile in that way, and I probably already service a bunch of high net worths and a bunch of large established non-financial businesses that have tax efficient strategies. I don't want to risk those guys. because that business is incredibly low risk. It's all transaction fees. It gives me minimum balances to increase my loan portfolio. Why would I risk that? Why would I give you access to the correspondent banking network that those high value clients have if you have a high amount of RFIs, chargebacks, fraud cases? And why would I give you access to that even better if I run the risk of being in a headline somewhere that you facilitate pig butchering, that you facilitate romance scams, that somebody sold their house, gave up their retirement savings, and fell for a boiler room fraud scam? Why, as a bank, would you do that? So, what metrics actually prevent account termination? Your actual transaction volume, the revenue that you generate for the bank, your average minimum balance that contributes to their loan portfolio, and how well you manage and diminish the overheads that they have to incur in order to manage you. Additionally, beyond all that day to day transactional based stuff, how well are you going to perform when they are audited? And I think there's a song called like Belshazzar, like, if you are weighed in the balance and found wanting, that's it. If you are the reason that your bank fails an audit, if you are the reason that your bank loses a correspondent account, or if they have reason to believe that you will be, because you're the future of money, you're freewheeling, you're whatever, but you don't necessarily understand any of the basics about how people make money and how much it costs them to make money, you're never ever going to be in a scenario where you get 12 months runway, where you get enough time in order to make it worthwhile for the bank. And if you're a startup with no transaction volume, if you're not willing to pay a monthly minimum, if you're not willing to make it profitable for the bank to monitor you and give you the runway to start to be profitable, to start to be relevant, then you're not going to survive. Like